The American Jobs Plan was announced, and we covered that in a previous video. The second part of that was the plan to pay for the American Jobs Plan, which is tax increases. There's a lot here, and it's early, so a lot of what we might talk about will change rapidly. But let's at least, Mike, for the viewers, let's start with the overall description of what's being proposed here to support the American Jobs Plan.
The document that the Treasury put out, it has 7 main points as to what the tax changes could be. They're all on the corporate side. And there's a lot of detail there, but if you were to summarize them, the key metrics that we can talk about, the first thing is just increasing the corporate tax rate from 21% to 28%. So undoing roughly half of the corporate tax cuts from the 2017 Tax Cuts and Jobs Act. It doesn't seem like there's any magic to the 28% level. This is sort of a negotiating tactic. This is a starting point. Wouldn't be surprised if this were to, when it comes out in bill form, get negotiated down to 24, 23, something like that. There's a lot in the bill about a global minimum tax. So the Biden administration seeking to work with G20 or OECD nations to coordinate a minimum tax to prevent corporations from moving income into lower tax jurisdictions, and basically everybody getting on the same page that we all need tax revenue right now. All of our budgets have a hole blown in them from COVID. So, and also stopping this idea of a race to the bottom, which debate.
And a lot of this it's labeled as a tax increase, but it's also a tax fairness, because there are a lot of organizations, a lot of companies that don't pay taxes at all, right?
Yeah, right. And so that speaks to another key component of the bill, which is enacting some type of a minimum tax on book income of large companies that report high shareholder profits but have little taxable income. So you think, like, what does that even mean, and who would that even apply to? And if you look through data on U.S. listed companies, this would only apply to about 45 companies at this point. And it's just situations where, you have a company that has made a huge fixed capital investment that for financial statement reporting purposes, they can depreciate over time. And so it doesn't have a big hit to the bottom line. So they can report larger profits now, but for tax purposes, they can write the whole thing off and reduce their taxable income. So situations like that, this is more like a backstop. And to your point, this is not really going to generate that much tax revenue. It's just a fairness thing. It's really just a fairness thing. And then there's more on the idea of taxing income earned overseas through intangible property, intangible assets, which we can get into, the GILTI tax, the GILTI tax. We don't have to get into too much detail there, but once again, talking about tax fairness and reducing the incentive for multinational corporations to make profits overseas and avoid taxation in the U.S.
Right. A lot of this proposal will be negotiated, and we have to sort of start to handicap what is likely to pass. And you hear both sides talk about the tax rates, and globally we're uncompetitive or we are competitive, et cetera. And we have a graphic here that really shows what the actual tax rates are. So take us through this.
Yeah, this chart, the electric blue line shows the combined aggregate corporate tax rate for the United States. So not just the headline corporate rate, but also factoring in state and local. So you can see we were running at 38.9% before 2017, where we cut it down the headline rate to 21%, which after you factor in state and local brings us to right now about 25.8%. And that puts us slightly below the median of the G20. And so that's the dark blue line, and within the range, certainly within the range, the lower end of the range, which is the gray area. So
regardless of what you hear, so regardless of what you hear from either party, the rates are generally competitive here.
Yeah, at this point, definitely competitive. And And the Made in America tax plan suggests a headline rate of 28%, which you factor in state and local, that gets you to 32.3%, which is upper end of the range above the median of the G20. So you could see if this thing got negotiated down to 24, 25, we'd probably be reasonably competitive in terms of corporate taxes. And then I think another key part of this is getting the members of the G20 to negotiate on the global minimum tax rate. Because if we're going to raise our rate, then another way to make sure we're competitive is to make sure everybody else is right up there with us or closer to us. You bring up the bottom. So that's another part of this.
Raising and enforcing. And
that's
a big part of this. And I think the IRS is looking at additional resources to support any of these tax changes at the corporate level that we might see. So more to come there. But in terms of handicapping what's likely to happen, what's not likely to happen, I think, the one thing we do know for sure is that anytime there is a corporate tax increase, it is not borne by the corporation. I mean, they are essentially just a pass-through entity for the tax, which is borne by the workers, traditionally in the form of lower wages and or fewer job availability. It's borne by consumers in terms of higher prices, and it's borne by the investors or shareholders through lower dividends. And that's generally, in all cases, what happens. So let's talk about sort of what we think might happen and what the reality or fairness is in those cases.
Yeah. And just piggybacking on what you just said there, this piece of the combined plan is where there's no Republican support, right? I mean, we talked about how you can get Republicans on board with spending, most likely, certainly some parts of the spending part of it, but there seems to be absolutely no Republican support for tax increases in this part of the tax plan, or certainly any individual tax increases that are going to go along with the American Families Plan.
And let me ask you a question. Do you think that is because there's so much social infrastructure in the proposal that they're trying to fund, or do you think that if they can cut some of that, you might get some Republicans on board?
On the spending side, I think that's fair. Yeah. If there certainly is bipartisan Republican support on the traditional infrastructure measures. So, and a lot of the social infrastructure components, there could be Republican support. It's just kind of too early to tell. As we get through the negotiating process, what you'll find out is actually there's probably more Republican support than you originally thought. So we'll sort of see how all that plays out. If any of these tax proposals were to get through, they would have to go through the budget reconciliation process, which is the same process that was used for the American Rescue Plan. And if that's the case, then a couple things are likely to happen with that. One, they probably wouldn't be negotiated until the fall, which that late in the year means they're not going to be applied, if they're passed, would not be applied retroactively. It would be proactively, most likely. So you're talking about, if these things are to pass, kicking in 2022, early 2022, and midterms are right around the corner. And in the budget reconciliation process, although it worked for the American Rescue Plan, the margins are slim for the Democrats. You're going to have to, in the Senate, they can't lose a vote. They have to get every Democrat vote. And then in the House, they can only afford to lose 5. So it's going to be a difficult negotiation on this side of it. If you think, there have to be some Democrat members of the House or the Senate that are thinking, why talk about tax increases right before midterms? Let's just table this for a while. I'm looking to get reelected. The economy's recovering. You look at interest rates, you look at inflation, you look at the dollar, you look at the budget projections. The budget's naturally going to get better as we come out of COVID. There's no impetus on the tax side right now. So this will probably get watered down, get broken up, get drawn out. It's totally possible that out of this huge, bold plan, both parts of the plan, the spending and the tax side, that the only thing that actually gets passed this year is traditional infrastructure of around 400, 500 billion. That's a highly likely outcome.
Right.
So, it will be very interesting to see how this all gets played out and broken up and watered down, et cetera.
And then as you look forward into the American Family Plan, like what are the ideas around the likelihood of that type of legislation getting through?
Well, once again, on the spending side, there's going to be bipartisan support, and that's where you're going to see more impetus from the Democrats to get that through before midterms. But the tax side of that, you're going to run into the same type of issue. So if the American Families Plan comes out relatively soon, then we can look at all the spending together and say, let's carve out which parts of these we have bipartisan support that we really want to get done in the immediate term, do one spending bill and get that passed bipartisan, and then look at the tax aspects and run them through that thought process we just went through, which is that there's not going to be any Republican support. It's going to be budget reconciliation. And so maybe it's just one tax bill and they try to go for it at the end of this year and see what happens. But maybe it's not revisited until after midterms in 2022.
Yeah, I think that was our initial thoughts when Biden won, that it would be hard for them to pass any tax increases prior to midterms. So
yeah, we're already at the point where over half of government expenditures are not funded by taxes at all. It's just all deficit spending. The money to pay for, more than 50 cents of every dollar that's been spent over the past year by the government was just created or printed or borrowed, however you want to look at it. So you're getting to the point, you project this out and you say, well, what if we're at 80%? What if we're at 90% of government expenditures are just financed by deficits? And eventually you get to this idea of this logical question: what is the point of taxes at that point? Why do we go through all these negotiations and what are we doing here? And that, that's where you start to get into more of an MMT type discussion where taxes are not used to actually finance spending. We all know that's not how it works now, right? We don't, any of these bills, it's not like we need to pass the tax side first, wait until we get the money and then spend it. That's not how it works. They're just more of, how do we regulate the speed of different areas of the economy? How do we ensure equality? How do we incentivize different things? That's the only purpose of taxes, you'd say.
I've heard that taxes are they are not a way to fund spending. They're just a way to incent people to work, because you have to pay your taxes, so you work. And it's an interesting argument. Let me ask you this question: at what point, and we may be past this, are we at a point of no return where you're not just going to be able to tax yourself back into prosperity?
So that is a very big question. Typically, the points you hit along the way are in terms of inflation, devaluation of your currency, rising interest rates. So you don't know what the point is, but you start to see those things. Those things run away from you. And there's more and more research being done about this topic. And one other element that goes into it is, you never really, it never really goes off the rail until your democratic system has effectively collapsed on itself for any number of reasons. But yeah, that obviously needs to be unpacked more.
Yeah, that's great. Well, it should be an interesting summer as these items get debated and we see what the outcomes look like and what the counter proposals are, and as we move forward.